What up, Hyperchange? Welcome to another episode. Today we've got some really exciting stuff lined up. We're going to nerd out on Tesla's financials. I'm personally super stoked for this episode. We've got Mayur Thaker as a guest today. He works for Zacks. Friend of mine on Tesla Twitter, putting out some amazing research. And so I kind of wanted to dive into his charts, his thesis, and really get into the weeds, dive deep onto Tesla's transformation since the Model 3, because a lot has transformed about the profitability and cash flow profile of the company. And I think that really explains what we're seeing in the market now in terms of the company's outperformance. So this is like the perfect time to dive deep on all this. Really excited to have you on the show, Mayur. Thanks for coming on.
What up, Hyperchange? Always
So,
wanted to say that.
Yeah. So maybe you could start with, you sort of had this thesis of the triple threat of Tesla. Three things are driving the stock. And maybe we could start there and you could break that down for us.
Yeah, sure. So I think there's a lot that's been discussed about Tesla, and I think one of the reasons, or probably the driving force behind this crazy run that we've seen in Tesla shares, I think are three particular developments that are happening. Tesla's revenue growth has been discussed ad nauseum, right? We know that revenue CAGR has been off the, it's like 50% over the last 6 years or so per year. However, what I like to look at is not just revenue growth and gross profit growth, but I like to look at the adjusted EBITDA line, which looks at not just top line growth, but also captures the operating leverage of the company. But overall, I think what's happening is we have growth, we have operating leverage that's kicking in. There's also increasing returns on capital. And this is an important concept because, growth is great, but if it costs a lot of money to achieve that growth, that puts a little bit of a damper in the return of the equity. So, you could have two companies and they're both growing at, say, 50%. But if one company requires billions of dollars of capital to achieve that 50% growth, and another company requires half of that, then the one that is spending less to achieve that same growth is going to outperform. So I think what's going on now is, a realization in the market that Tesla's growth is going to be better than, not just on a nominal basis, but on a per Capex dollar basis. And I think there's a couple of charts that we're going to look at that sort of illustrates that. So first is growth and operating leverage. Second is increasing returns on capital, which measures efficiency. And third is declining leverage. So that to me is a triple sort of play, a triple threat, all of which is affecting Tesla's cost of capital. And when the cost of capital declines, returns on the equity increase. So I think that's what's happening, and that's basically the summary of everything that we've, that we're witnessing right now with Tesla.
Yeah, and this is why I love your research, because us Tesla longs have really been saying for so long, this is a different type of company. Tesla's growing extremely quickly. You haven't been able to see the profitability potential of what Tesla can be, how exciting this business model is, because it's too early. But now we've started to get more and more, as Tesla's evolved, as they've come out with their first mass market vehicle, the Model 3, we're starting to truly get that data and that evidence that is supporting that long-term bull thesis of Apple of the automotive industry, higher structural profitability. Like, this is really a different beast and should be valued like something different than an auto company. And like you are building basically the data case for that. So that's why I'm so excited to kind of dive into this. So let's just get to the first chart. You brought up a global EV market share chart, I guess EV sales in general. And at a high level, EV sales are just about 2%, 3 million cars sold a year out of the 90 million in the world. So as much as we're excited about this green movement, like we're just scratching the surface on the disruptive nature of this trend, how far this, EV market has to go to just replace ICE vehicles. So what does this chart tell you about Tesla and why is it important to you?
Yeah, because I think right now, especially during this pandemic and the entire aftermath of that, the biggest question that people have now is, if we fall into a recession, what's going to happen to Tesla sales? If we see 20% unemployment, which I think is what we're going to get when the Labor Department releases the next jobs report, what does that mean for Tesla sales? Especially with $50,000-$60,000 cars. And I look at I try to understand that and approach that question by looking at market share growth, because we have examples in the past where companies like Amazon, Apple, Netflix, they all grew revenue even through the great financial crisis. Not to say that their shares didn't, tank. They did drop, precipitously, but they grew revenue through that entire crisis. And it's because they gained market share, such that it offset any losses in overall, revenues or overall sales of the industry. So even though retail sales collapsed in 2008, 2009, Amazon grew through that because they gained so much share. So I look at, what the market share growth has been for electric vehicles globally. And we see on this chart, essentially it's exponential. And it still stands and this is as of 2008. I believe it's even, it's even higher in 2019. But this is as of 2018. And the global market share for BEVs and, plug-in hybrids were about 2.2%. I think there's a lot of room for growth in that number, and we've seen that happen every single year, as you can see in this chart. So I think that there is a distinctive chance that even if we do have a global recession, if global market share of battery electric vehicles, say for example, doubles over the next 2 years, that in and of itself, I think is enough for Tesla to absorb any downturn in auto sales overall. So that's an important thing to look at.
Great point.
Yeah.
A couple points on that. The factory shutdown. If Tesla's factory is shut down for a really long time, there's no way they can grow. So I think in some ways this is kind of a unique situation, but I think at a high level, like, you're on point. Why did Tesla grow their deliveries 40% last quarter? Even though they were shut down for part of it and we had this whole, catastrophe, they still were up 40%. Everyone else in the auto industry is down. So we're actually, just based on Q1, seeing evidence of exactly what you're saying. So now let's move into the quarterly trailing 12-month revenue growth. So this basically adds up the last 4 quarters of revenue. Maybe you could break this down for us. I see Tesla scaling to about 24 billion. It seems like we've hit like a sort of pause as they reach capacity of the Model 3 production line. And that's what's interesting about Tesla, is so much of their growth and their trajectory is guided by their ability to increase production. And so now that we have them bringing on Model Y, bringing on Gigafactory Shanghai, additional production, this number should start to go up. But what does this chart tell you? Why is this important?
Yeah, so just really high level, the way I interpret the revenue growth, or just revenues in general for any company, is it's essentially a reflection of the sheer raw demand for the products, right? So, Tesla could have industry-leading margins or whatnot. It could have the best profitability or whatnot, but revenue is basically a reflection of the demand for the product. And, the big question a couple of years back was, what's the demand for these vehicles like? Are consumers going to be willing to take on, the slight, inconveniences of an electric vehicle, right? You have to charge, find a place to charge. You have range anxiety. You have other issues. You have, not as robust of a service network, and things like that. So the big question is, are consumers ready to adopt electric vehicles? And so I look at the revenue growth, and that's telling us exactly that, it is catching on. It is gaining share, as we saw in the previous chart. So revenue growth itself is just a raw, measure of demand. Now, the next chart, however, which is the Tesla gross profit, right? That tells us, what is the raw, measure of profitability. And it's this number where I think it's going to get really interesting over the next year or so, because of another chart that Tesla showed on one of their previous shareholder letters. I think it was from Q3 of 2019. But basically, it was a small little bar chart. It was a tiny little chart that they had in that. where they showed the total capex that's required for the Model 3 built in Fremont. Next to that is the total capex of the Model 3 built in China. And then next to that is the total capex of the Model Y. And the Model Y is significantly lower than either of the previous two. So the most expensive car was made in Fremont Model 3. Significantly cheaper than that is made in China Model 3. And even more significantly cheaper than that is the Model Y. So I think, with the effect of the Model Y, you're going to see not just a bump in revenue, because the Model Y is attacking a much bigger segment, but you're going to see a greater bump in gross profit. So revenues may grow, say 40, 50%. I'm not sure exactly what it's going to come out to in 2020. But gross profit is actually going to grow, in my opinion, even faster than revenue growth, because the incremental Capex spend, therefore less depreciation, is a lot less compared to Model 3.
Yeah, and this is a really interesting part that I think maybe you glossed over because it's kind of complex, where Tesla has to pay for these production lines up front to build a car. And Tesla's a new company. When they built their first mass production line for a Model 3, it was kind of a disaster and a mess up. That's why it took so long. They had to build the GA4 in the tent. There was all these sort of hiccups, but they learned from that, and all these efficiencies we're seeing financially play out in reduced Capex per unit of output, which is that metric you're saying. And so can you really dive deep into how that metric impacts gross profit? Because my understanding is it's less of a cash thing where it's like they paid less to build out all of these production lines. So that depreciation of those production lines is less when they go back and actually start pumping out cars. So that's why in theory, we haven't really seen the impact of these Capex improvements on the income statement until we see production ramp from Gigafactory China and from Model Y, because that's when that incremental depreciation will be that, cut in half per unit. So is that what you're talking about, of where we're going to get to see that Capex improvement start to show up on the income statement this year?
Exactly. Yeah. And there's a direct link between depreciation and Capex, right? Because Capex is the amount of money that's spent to acquire all the tooling and the factory itself, right? And building out that factory. So as that is spent up front, it's then depreciated over time, which hits the income statement over time gradually. Whereas, if you're looking at the cash flow statement, it actually hits right up front. So it's not a recurring charge. It's a one-time hit all up front. However, with the Model Y, I think, and given all the tidbits that Elon has given, even on the most recent Third Row, Tesla podcast, I think he pretty much reiterated that same point, which is that, Model Y, it's not going to be very different from a user standpoint compared to Model 3. But the internal sort of, complexity of the body itself is so much simpler than Model 3 that the amount of Capex that's needed to build it out is going to be significantly less than Model 3. And I think we've already seen that because, throughout 2019, there wasn't a whole lot of Capex that Tesla, put out there. They were way below their forecast. I think they spent about 1.5 billion or slightly less than that in 2019 on Capex, which is very low. It's almost too low to believe, but that's going to pick up this year. So I think their guidance this year is about 3 billion in Capex, which is, a doubling from last year. And that's probably expected because, the ratio of Capex to depreciation had fallen basically below 1. And usually companies can't ever sustain that. That's never long-term sustainable because you can't spend less than what it takes to maintain your existing factory and tools and things like that. So it can dip below 1 for a while. There's many companies that have this. Amazon is below 1. Home Depot, I was looking, is also below 1. So many companies can have Capex that's less than depreciation for a while.
And that's because it's really cyclical, right? It's what we're talking about is that's why Tesla looks so like a juicy business the past year or so, because they put in all this Capex in 2017 and 2018 to build up those lines. And then now they didn't really put in CapEx. They're just taking out all these cars and all these non-cash expenses. But then it's very cyclical. And that's why I always say, like, man, this COVID hit at the perfect time for Tesla, because they were at this part in the cycle where they had the most cash than ever, and they're about to pump in all this excess cash in production, and they can kind of wait and slow that down, as they see demand playing out. But anyway, so I didn't want to interrupt, but.
Yeah, no, that's exactly it. Yeah, so we're going to see that wax and wane over time. It's going to be cyclical. I know it's been one of the big, talking points of the short sellers that, they're super underspending on CapEx. And I think that's a fair point, and that's going to come back up.
But it's also like, so you're getting mad at Tesla because they're getting, like, their, bear case is actually our bull case. I'm like, yeah, you're baffled about how little they're spending on CapEx, and it doesn't make sense to you because you refuse to acknowledge that Tesla's rate of improvement at actually building out these production lines is getting way better faster. And that's the big difference. And they just refuse to acknowledge that.
Yeah. No, exactly. And as another chart is going to show, coming up here, the one of the biggest bear talking points is that, Tesla is a capital intensive business, just like every automaker out there. And yet they have, they're trading at a massive premium, to everybody else. And we're going to see, I think, why that is. And it's specifically due to this one point that we're discussing right now, which is the ratio of revenue to CapEx, and also the ratio of EBITDA to CapEx. I think these two things are going to be critical to understand why Tesla is not anywhere close to being as capital intensive as the overall auto industry. And Model Y, I think, is going to be where that finally reveals itself. So starting this year, we're see that.
I can't wait. So we're getting a little bit ahead of ourselves because you're jumping like charts 10 and 15. So can we get to this adjusted EBITDA? So this is the next metric after gross profit. And yeah, just dive in. I'm a little bit skeptical of adjusted EBITDA. I think it's important to understand, but it's also one of those PE guy metrics of like, we bought this business that invested all this money in these huge equipments. Now they're just a cash cow. We want to look at the financials without all that legacy investment. And, it's kind of like a finance MBA bro PE guy way to value things, which is what frustrates me. It's not like a real metric. So why should we care about Tesla's adjusted EBITDA? And why are you looking at it?
Yeah, sure. So let me preface by saying adjusted EBITDA or even EBITDA is not net. I'm not claiming it's net income. It's not GAAP net income. It's not the bottom line profit number. What it is whenever you're looking at a hyper growth company, the job of an analyst should be to be able to separate as much as you can between discretionary spending and non-discretionary spending. Discretionary spending refers to the spending that they're doing around growth, around achieving growth. Non-discretionary spending is the spending that's required to maintain present day operations as is going forward. So what the adjusted EBITDA number does, and the way that I calculate this is simply using EBIT, right? We start with EBIT, and then what we do is we simply add back depreciation and stock-based compensation.
Which is on the cash flow line. So you go into the cash flow line.
You go into the cash flow statement, right? Okay. Add that back. So the reason why this is important is because it helps separate a little bit of that growth spending from non-discretionary spending. It also captures in a more easy to identify way the overall trend of operating profit. So if you look at this chart, you can actually see, and it's very easy to annotate this chart just because we know Tesla, we know the history of Tesla. But you can see that, from 2013 onwards, you can see that, rise of adjusted EBITDA. And that was attributable to the Model S ramp, right? Then we see that number start to wane again, and it actually goes into slightly negative territory, by 2015. And that, just because we know the company, that was the, Tesla going back into R&D mode to bring out the Model X. So then we see that surge in, I think it's right around late 2016. That is the surge of both Model S and Model X together. Okay, and then Tesla once again goes into R&D mode, and that's why we see that adjusted EBITDA line, once again wane in preparation for Model 3. Then once Model 3 is fully developed and ramped, then you see that huge jump up again in adjusted EBITDA. So you can see the cycle of, the development to the development cycle to the ramp up cycle, development cycle to the ramp up cycle. So it's going waxing and waning like that. So that when you look at it in this way, it helps you understand, what exactly Tesla is doing and how that's, affecting not revenue growth and not, GAAP net income, but right in the middle there, which is that EBITDA line. So again, this is my way of just looking at the cash component of EBIT. So we take EBIT and we add back the non-cash expenses, and that gives us this number. The reason why it's important to look at this is because I think it's a leading indicator for net income. Net income, if we look at the next chart, net income has been negative, throughout Tesla's entire history, right? And we can see even for non-GAAP net income, it's been negative, but that has now flipped and is positive now very slightly, but still positive for the full year. So that, I believe, is the first time Tesla has achieved net income on a non-GAAP basis in positive territory here. So
these are all last 12 months. So it's the past 4 quarters combined,
exactly,
which you do to kind of smooth out the quarterly lumpiness, I'm guessing.
Right. The other thing about the adjusted EBITDA number is that it helps capture not just the top line growth, but also captures margin improvements at the gross profit line, as well as whether there's operating scale that's kicking in, right? And so we know that if we just look at the revenue CAGR has been about 50% over the last 6 years. And the EBITDA CAGR has been about 67%. So when you see EBITDA outpacing revenue growth, that means that there is operating scale that's kicking in. And that's exactly what we need to see in order for net income at the GAAP line to flip positive. So this is going to happen first, and then GAAP net income is going to happen afterwards. So as long as we see this trend continue, where we see, the adjusted EBITDA line increasing, going up and to the right, that is the leading indicator for GAAP net income to flip positive again. So, and we saw this, with Amazon, from 1996 to 2003. There's a period of 7 years where they produced, GAAP losses the entire time for 7 straight years, but their EBITDA was growing during that entire time. So EBITDA for any capital intensive business is going to flip first. And as long as it continues to grow, that will ultimately reflect in the GAAP net income line. So I think that as long as we see a growth in EBITDA further, and as long as it outpaces revenue growth, which it has been, we will see GAAP net income flip and go to the positive, back into the black.
Yeah. And just before we move into this cash flow piece, what basically the difference in that adjusted EBITDA line and the GAAP income is all of these additional non-cash expenses and then business expenses that aren't necessarily tied to the core business, maybe interest on loans. So you're not saying that it doesn't matter that they're losing income on a net GAAP income basis. Just when you read in between the lines, you can kind of see why. And there's a lot of reasons of why, like there's silver linings, and we can see that this is improving and has a path to improvement. But so like why are you not, I guess, like diving into the GAAP net income? Because it's like the worst looking chart. So I want to kind of like give that time. Like, why does that not bother you? And how do you expect Tesla's GAAP net income to kind of trend? Is it going to stay sort of negative around break even for like a long time? I think that's what Elon's guided, at least until robo-taxis really hit, because just like Amazon, growth mode.
Mm-hmm. Yeah, I mean, obviously net income GAAP is important, right? It's the ultimate measure of profitability. It's the strictest measure of profitability. However, like I said before, the job of an analyst when looking at any company is to ask why. right? Why is GAAP net income positive or why is it negative? Some people can achieve high net income on a GAAP basis by simply restricting Capex. They can achieve positive net income by restricting R&D, right? And we see that happening now with companies across the board where, they're cutting Capex, they're cutting R&D, they're cutting everything that's not needed to be able to survive this crisis, right? So, yeah, they could achieve GAAP net income, but is that really what we want to see, for companies? So, Tesla could achieve, I think they could achieve GAAP net income if they simply stuck to making the Model S and X, right? If they just did Model S and X, they focused on selling $100,000 cars or $120,000 cars and did not invest in, high scale production and international growth and expansion. I think they could be like a Lululemon of the auto industry. They could be like another Ferrari. However, that's not the vision of the company, right? The vision is to achieve, advance the, entire movement towards sustainable energy.
Right.
So GAAP net income, I think, is important to consider, but I don't think it's the number that we should be really focused on as much. In my opinion, I think free cash flow is the much better measure of profitability than net income, because at least that number looks at whether the company is burning cash or generating cash. And ultimately, cash is the more important number rather than accruals, because everything on the income statement is on accrual basis, right? Income and expenses are recorded when they are accrued. Whereas the cash flow statement looks at how much cash is leaving the business and how much is entering, the business. So in my opinion, and a lot of investors actually, a lot of, big time investors agree with this general statement, not specifically on Tesla, but just in general, that free cash flow is a better measure of the health of a company than GAAP net income.
Yeah, because you can't play games with it. It's like, did your cash in your bank account go up or down? Usually, barring some crazy situations, that's a pretty good sign of how your business is doing, and very hard to misguide someone. But at a high level, I think, just to sum up before we dive deep into this cash flow point, there's a company behind every stock. Tesla's not trying to maximize profitability right now. And if they wanted to, the company would look totally different. They're trying to grow and get way, way bigger. And that's why the financials look like the way they do right now. It's not like they're struggling to make money and they can't. It's like they're literally moving 1,000% in investment mode pretty much at all times, like a la Amazon, which is a totally crazy way of how companies have never really been run before until Jeff Bezos and Elon Musk. So I want to get to that at the end of this. But with that, so let's talk about the actual cash flow generation of Tesla's business, because this is where the rubber meets the road. And this is what every single bear short set, this is the chart to me of why Tesla stock has gone to new highs. This is why the short thesis actually crumbled, because what they said Tesla could not do was actually make money. And the second 4 or 5 quarters ago, they're printing 400 million in the bank, 500 million in the bank, just like you're saying. Cash flow. It's pretty hard to say Tesla loses money on every car sold when they keep adding hundreds of millions to their bank account every quarter, selling tens of thousands of cars, right? Yep. So, so with that, let's dive into, you got operating cash flow. We can start with that.
Yeah, so this is, I think it's very, very related to the adjusted EBITDA number, because the only difference between operating cash flow and adjusted EBITDA is the cash flow statement starts with GAAP net income and then starts to add back all the non-cash expenses. So this number is going to correlate very closely with the adjusted EBITDA number that we just looked at. So in my opinion, I think the operating cash flow number is the most important, metric to look at Tesla's growth, from a bottom line standpoint, that is. The top line obviously is important with, revenue growth, basically telling us how strong demand is for these products. But the cash flow number, in my opinion, is sort of the number that we should be looking at when assessing their profitability. Now, it's not profit, it's cash flow, right? So those are two sort of technical terms that you have to distinguish between. But if you want to know, in my opinion, the operating cash flow line is the number to watch to understand how much is Tesla actually bringing home, in the bank, right? The free cash flow number looks at operating cash flow minus Capex. So that's the net number that's being added to their bank account. But I would look at this number too, and as long as it's above zero, that's basically my minimum requirement, because as long as they're not burning cash like they used to, you can see that number has flipped pretty decisively now, where we've got 3 quarters in a row that we've seen trailing, 4 quarters of free cash flow being positive. And it's almost at, it reached almost $1 billion at one point. Now, I'm actually using a slightly different definition of free cash flow here, which is that I take the operating cash flow minus Capex, and I also subtract out the finance lease payments that they've made. So this is important because a lot of what they've done at Gigafactory 3 in Shanghai is they've arranged the acquisition of a lot of those tools under a finance lease sort of arrangement. And a finance lease is basically just like, the simplest example is like a mortgage, right? If you buy a house on mortgage, you pay in, monthly installments, and over time you build equity into your house, but you get to keep the ownership of the house and you get to own it over time. So in the same way, a finance lease is basically, when Tesla acquires tooling and, parts of the factory and other things like that, under a seller provided financing. So over time, they have to acquire it. Basically, they get it all up front, but they recognize these payments over time. So that's technically also Capex. So I sort of add that back as well. And even after that, Tesla is positive on free cash flow. So that, to me, is the most important trend shift that we have seen through the entire history of Tesla, where for years and years, right, they burned cash. They not only were net income negative, but they were also burning cash. So that's not sustainable. So they were dependent on the capital markets to be able to finance that entire thing. Now they're not dependent on capital markets anymore. And I know that they just raised, $2.3 billion in equity just a few months ago. But if this number continues the way it is, that's going to be just, essentially a safeguard or sort of a rainy day fund or something like that, because they just did, $750 million last year in 2019, according to this metric.
Right.
Cash flow.
And if you think about this, is like, to me, the biggest milestone in Tesla's history. We have an asset, this crazy electric car company that is burning, billions. It looks like the product's awesome. It looks like it has all this potential, but like the financials, because they're so vertically integrated, it's so capital intensive. And people will say Amazon got profitable faster, Amazon's Capex was less. I think Tesla's way more capital intensive per dollar of revenue than Amazon. So you have to look through that lens. And we finally, like even way more than I would have expected 2 years ago, like we've truly seen that dip to like, this is an asset that pumps out cash. And I think that, and like you said, they don't rely on the capital markets. This is why Jim Chanos's entire thesis is wrong. You have to keep raising money. Well, now Tesla doesn't. They can use that cash from their core business to fund it. They're no longer reliant on this perceived solvency thesis where the stock market has to believe they'll succeed to keep giving them money. It doesn't matter because they can get money there on their own. And I think this single-handedly stopping being reliant on the capital markets is why the stock has gone up. Like, you can't take this down with fear and trying to freak the market out, because it doesn't matter, because Tesla's not relying on that as much anymore. So I think this is like, this chart is truly the evidence of the biggest transformation in Tesla's business, sort of a growing up, maturing phase to like becoming a grown up almost.
Exactly. Yeah.
And actually, sorry, I forgot to add on that. Amazon, the first thing they say in their earnings releases is operating cash flow is this, and then Capex is this. These are before they're talking about earnings, if you go read their press releases. So I think when we're talking about these rapidly growing companies that are managing the profitable operations with cash coming in and immediately reinvesting it into these new things, this is almost slowly becoming one of the new most important metrics in finance for these new sort of hyper change, rapidly growing firms.
I would 100% agree with that. I think free cash flow is the ultimate measure of whether the company is sustainable or not. So if free cash flow is negative, that means that the company is reliant on debt and equity markets. If free cash flow is positive, they're not reliant on debt and equity markets. So now that this number has flipped positive. Now I will say that I think Tesla's Q1 is going to be a little bit rocky. So I think that number on the free cash flow line is going to be close to about negative 850 million, according to my calculation.
But comp that to Q1 last year, it's not actually that bad. And
Yeah,
it's more Q1 is Tesla's worst quarter from a cash flow standpoint throughout the year. So,
right, right. Yeah,
but Q2 is going to be awful too because of the whole COVID situation.
right. Yep. I would totally agree with that. But in general, I think overall for the year, I think they're going to do another billion total of free cash flow, and despite
Wow.
that's despite the fact that they're doubling their capex spend this year. So I think they're going to do about 4 billion in operating cash flow this year, minus about 3 billion in capex. That leaves us with about a billion overall
And that is,
cash flow this year.
and when are you gauging a mental reopening of the U.S. Fremont economy and plant? What goes into that estimate? Because that would mean, that's a very good thing for Tesla.
Yeah, I think it's gonna. I think I just got a notification just earlier saying that New York is going to be opening up on May 15th. So I think if the state of New York opens up on May 15th, I think California should be right around that target. Maybe even slightly earlier than that. So I'm just, in my mind, thinking that Fremont is going to be down until about May 15th, or in that ballpark.
And then a slow reopening, and with that kind of trajectory, that's where your head's at for all these estimates.
Yeah.
Okay. And
Exactly.
so this next chart here we dabbled a little bit on before, revenue capex ratio. Talk to me about how you're calculating this and why it matters.
So this number is important to understand, right? As I said in my point earlier, growth is great, but if it's expensive to achieve that growth, then you have to sort of caveat that, right? So this chart, to me, is critical to look at and pay attention to as we go over the next couple of quarters, where we're going to see Tesla's growth in revenue going to exceed the growth in capex significantly, in my opinion. And we've seen that starting to happen all throughout 2019 versus 2018. So as this number is rising, it's telling me that the cost per dollar of capex to achieve each dollar of revenue is decreasing. So the total revenue per capex dollar is going up. So that to me means that growth is getting cheaper for Tesla, not more expensive, or not even staying the same. And the same principle is applied to the adjusted EBITDA per capex dollar, which is the next chart here. And this to me, I think, is going to go significantly higher, because this will capture both operating leverage and the increase in gross margins that we're going to see with Model Y, as well as additional revenue recognition from FSD as well later this year. So these two numbers are important because they relate to this concept of return on capital. Return on capital is basically the ratio that looks at return on assets or return on equity, right? So again, it goes back to the idea of, growth is great, but as a shareholder, what type of return am I seeing per dollar of capital that I have given to the company?
And this is what Buffett would be paying attention to. This is the kind of thing Buffett and Munger are going to look at when they look at what is the return on capital invested in a new project for this firm. And this is what you're about to say is why Warren Buffett should be putting every single dollar he can into Tesla, because my opinion is their new gigafactory, their new factories they're building, which is totally, you can't see the full effect of it because it still has the old factories in the numbers, is such a high return on capital. The capex is so low for dollar of output, for dollar of gross profit, that it is like a no-brainer. It would blow away any ROIC model that any automaker has for any auto plant probably in decades. And so if you're sitting in a boardroom and you're Volkswagen and you're Chrysler, this is the math of why you're like, I want to buy 10 gigafactories from Tesla if I can and start building them tomorrow, because for every dollar I invest, there's literally not a better dollar to invest than building a Tesla gigafactory right now, if you're from like an automotive capacity standpoint. I'm just so, that it's because people hate on Elon Musk. They're like, Tesla can't build cars. Everybody can build cars better than Tesla. And Elon's like, it's all about pace of innovation. And here we're seeing that the pace of innovation that Tesla has is so fast, they've actually totally surpassed everyone in the auto industry in this metric. And that's something that nobody thought was possible.
Yeah. And the only issue that I see, though, is that, well, from the perspective of classical value investors, is they calculate this return on invested capital, ROIC, or return on capital, return on assets, return on equity, all of these ratios using net income as the numerator, and then using total assets as the denominator, or total shareholder equity as the denominator. So of course, if you use that calculation, then it's going to be negative for Tesla, right? Because their GAAP income is negative. But if you replace that with another metric, which is also popular, CFROI or CFROA, that's the cash flow return on assets or cash flow return on equity. That number is, as of right now, competitive with the big four or the big three automakers, namely GM, Ford, and Fiat Chrysler. So those numbers.
That's this Tesla FCROI TTM. It's like it was negative for a while. Now looks like it's about 5%.
Yeah, exactly. Yep. It was negative for years because free cash flow was negative, since inception. But now it's flipped positive, and you can see that. And I don't have the. There's another chart that I'll send you after this, but it's basically comping Tesla's free cash flow return on assets or return on investment with GM, Ford, and Fiat Chrysler. And you can see that Tesla is already competitive with them right now. So that goes into one, point that I made in the triple play, which is what I was alluding to before, which is that there's growth, hyper growth, but there's also very competitive return on capital. That measures the efficiency. For a given set of assets, Tesla's producing this much in cash flow. Relative to other automakers, that's very, very competitive. It's actually right in line with what they're doing right now. If you look at other automakers' cash flow relative to their assets and look at Tesla's cash flow relative to Tesla's assets, Tesla's right there in the midst of the other guys there. So that measures the extent to which Tesla's producing cash flow per dollar of assets, or cash flow per dollar of equity. So me as a capital market participant, because I'm an equity holder, I like to look at, cash flow relative to equity. Or if you're looking at, trying to understand, is Tesla being efficient with overall assets? Then you want to look at cash flow relative to assets, right? CFROA. In both metrics, Tesla is competitive with the industry average.
But we don't want to look at that metric. We want to look at the rate of change of that metric.
Yes.
And if you look at that, it's like,
Exactly. And I think that's what's going to reveal itself. It's competitive right now as of Q4 2019. What happens in 2020, I think, is going to make it's going to make the difference, because I think that's when Tesla will leapfrog everybody else, and we're going to see Tesla achieve the industry leading cash flow return on assets as well as cash flow return on equity. And we're going to see that, I think, this year. And that's why I think the market is starting to sniff this out. And that's why we see such a crazy run up in the shares, because of this particular fact.
Excellent. And so, now stepping back a little bit more high level, that was such a good breakdown of when we're buying Tesla, it's a vertically integrated, company with all these increasing metrics. When we're buying, Ford or GM, it's like they've outsourced everything. It's almost like a brand and a financing operation. How much of even apples to apples comparison is Tesla to these other automakers in a lot of these metrics? Because a lot of people will say like the price sales ratio of other automakers, price earnings ratio is so much lower. But I have to think that's because the growth is so low, and maybe because under the hood, these financials aren't as good as they seem. So could you help me try and bridge that gap of why Tesla trades more like a high growth tech company, not an auto company? Or that's kind of what has people so confused?
Yeah. So I think it's trading at a significant premium over the market, specifically over the auto market, specifically because of these three things. We see, 50% revenue CAGR, right? No one has that in the auto industry. We're seeing, an inflection in free cash flow and a growth in free cash flow that exceeds everybody else. We're seeing competitive cash flow return on assets, as I just mentioned, and competitive cash flow return on equity. At the same time, the other part of it, right, is looking at the cost of capital, right? And that's another thing that's a little bit more, clandestine. It's a little bit less understood, right? What is the cost of capital? So a stock can go up because it has increasing free cash flow or increasing cash flow. A stock can also go up if their cost of capital is declining, right?
Basically, when they go to get a loan, how much are they being charged?
Right. Yeah. So overall, both debt and equity together is the cost of capital. So what can drive the cost of capital lower? One of that is leverage risk, right? And so that's why we have this next chart here that looks at Tesla's net debt. And we see that it hit a very high level of around, I think, Q2 of 2018, where their net debt was about 9.2 billion. And net debt is just taking total debt, right, minus their cash on the balance sheet. So if you look at that, it actually dropped from, a high of 9.2 billion. It kind of bounced back a little bit there over the next couple of quarters. It, went back up to 9.1 billion. But then what happened throughout 2019? It dropped significantly from 9.2 at the high to under 7. That's a 25% reduction in net debt. When net debt goes down, that means leverage risk is going down. And when leverage risk goes down, the cost of capital goes down. When cost of capital goes down, the equity and the bonds go up. So that's why we saw bonds. If you look at the price of Tesla's bonds and equity, both are going up, in my opinion, because we see that there's effective deleveraging happening in the balance sheet. So 25% reduction in their net debt. Now, some of that is due to equity, right? Due to their equity raise, right? So if Tesla goes to the capital markets again and does another billion or 2 billion in equity, then of course their net debt is going to go down, right? Yeah. But as we saw in the previous chart, they're free cash flow positive. And free cash flow has nothing to do with how much they're raising in debt or equity, right? That's the core cash collection from their core business operations, including all of their growth spending. So yeah, it went down, and part of it is due to the fact that they did raise equity, but it's not entirely due to that. So as long as free cash flow is positive, the net debt will continue to drop. And I believe as of, by the end of this year, we're going to see net debt, almost cut in half from 6.9 billion to about 3.8 billion by the end of this year. So I believe that's my personal estimate, considering the free cash flow of 1 billion, the 2.3 billion in equity raise that they did, on top of the 6.3 billion in cash exiting Q4 of last year.
Yeah, and you're not even adjusting this net debt position for the size of the business, which is getting way bigger as well. So I feel like that's another factor at play that makes that kind of, basically de facto reduces the debt without reducing it, just because the assets are getting bigger. But
yeah, and that's why I have this next chart here, which looks at the net debt relative to that adjusted EBITDA number. And this is a metric used by a lot of folks to measure the effective leverage of a company. So we saw that it hit a very high level of, Q3 of 2018. So net debt relative to their EBITDA was, almost 14 times, which is very high, right? So there was a major risk, and a lot of, short sellers were right to point out that they are, heavily leveraged. So if revenue, or if something were to happen to their revenues, or something were to happen to their cash flow, they would be in trouble, right, with that high of a leverage ratio. But we saw, through 2019, that number dropped precipitously, from a high of about, 14 times down to 2.2 times as of Q4 of last year. And my prediction is that it's going to drop below 2 by the end of this year. Or sorry, below 1 by the end of this year. So
Wow.
that, and just to put that into context, investment grade companies, so I'm talking about like the Apples and Amazons of the world. Their average net debt to EBITDA is roughly 1, or maybe about, it ranges from between like 0.5 to 1. So I believe Tesla's net debt to EBITDA, and this sounds super crazy, I know how crazy it does sound, but I think that by the end of this year, we're going to see Tesla's net debt to adjusted EBITDA in line with investment grade companies. So the highest credit quality companies out there, Tesla's going to be competitive with them on a leverage ratio, on this particular leverage ratio.
Wow. And so when you take a step back and you look at all that, how this valuation, all these metrics are coming in line with Tesla, I mean, it's almost unbelievable for me to look at this and see how crystal clear this thesis is coming together from a bull case with the financials since the Model 3 launch. So, at a high level, just from the past 2 years, like what has surprised you about Tesla's execution, and, how confident are you that this like really is going to go all the way and be that, Apple of the automotive world?
I never would have thought that they'd be free cash flow positive at this point right now. My original model, I was actually just reviewing it, the one that I built in 2016. I didn't expect them to have a period of 4 quarters of positive free cash flow until 2021. So, they're about 2 years ahead of where I thought they would be on a free cash flow.
Wow.
Because I thought they would just continue to spend. They would have revenue growth, but they would have very poor, overall, free cash flow. I thought it'd be negative for many years to come. I thought they would just continue to raise capital, which they are, but they're doing it because they can, not because they have to at this point. So that is the biggest surprise. And, I think that, these numbers, it's easy to, be stuck in spreadsheets all day. When in reality, there's a real company that's doing, crazy things in, Gigafactory 3, where there's a learning curve, right? And I think they overspent in Fremont in preparation for Model 3. I think that's been well documented by this point, where, they had a lot of learning, hardcore lessons that they learned. And I think, as they continue to build out these new factories, I believe they're going to get more and more efficient with how they deploy their capital. So that's why I think the biggest trends to watch, these Tesla, is not just their growth, right? Not just how much, are they attacking new markets? Like we know that they're going to grow revenue because they're entering a new market with the Model Y. We know that this Tesla Semi is coming, which is personally my favorite. I'm most excited about the Tesla Semi. We know the Cybertruck is coming. We know other products are coming. So that's going to be sources of revenue growth. What's also going to be a source of revenue growth is increasing market share. So that's obviously there. But I think what's also important is looking at this concept of cash flow return on assets and cash flow return on equity. And it's already competitive with the big 3 automakers today, right now, as of Q4. And the growth of that number is such that I think it's going to leapfrog the others, by the end of this year. That's a big trend to watch. And then lastly, it's the fact that they're massively deleveraging their balance sheet. So we see the net debt number going down, and we see the net debt to EBITDA number going even further down, to the point where I think it's going to be, competitive with, investment grade companies. Now, do I think they're going to get an investment grade credit rating? I don't think so. But because, by the way, that number, net debt to EBITDA, is one of the major inputs that's used by the credit rating agencies. So when Moody's and S&P go out and rate companies, this is one of the things that they look at, is net debt to EBITDA. So if this number continues to drop the way that I think it will, I don't know if Tesla will get an investment grade credit rating. I think that might take another year or two, maybe 2 years, or maybe further than that. But they will get credit rating upgrades, that's for sure.
Excellent. And so one trend that I've been watching in particular that I feel is very sort of overlooked because it's never happened before is this FSD software. Tesla sells, $7 or $8 grand for an additional software package for their vehicles, which is almost unprecedented in the auto industry and not a one-off. They're raising the prices. They're planning another price raise soon when they come out with stoplights and traffic lights, which is going to be epic. But my point is, as the price goes up of FSD, as more of the vehicle's ASP goes to software, as the attachment rate goes up for FSD, like Tesla's changing what it is to sell a car and the potential gross margin structure of that. And so, they sell $8,000 package. They are able to recognize that revenue over time ratably as they release these features. So they're almost building up a deferred revenue backlog where they get cash up front, like a SaaS software company, into their financials. And so how do you think about this component? Because to me, this is the big, this idea that Tesla can capture huge incremental software margins on the road to full autonomy. They don't need to have a full autonomous robotaxi to start to dip into these huge game-changing software margins for the business model. So how do you think about the price raise of ASP and the attachment rate and what that's going to do to this entire model? Because we're seeing Tesla's getting better at building the cars. That's one thing. And they're getting way more profitable at doing that, and they're selling them profitably. That's exciting. They're going to keep doing that. And then we have this other sort of gravy on top, which is they're also selling software more profitably on top. There's almost 2 mega tailwinds for the profitability of each sale of a Tesla. So how is this software layer factoring into your thesis?
Yeah, I think the revenue that's associated with the sales of FSD are sitting on the balance sheet right now. A lot of it is sitting on the balance sheet because, since they're selling a software option package that isn't fully ready yet, they can't recognize that revenue, right? So it's not revenue that's recognized, but it's deferred revenue that sits on the liability section of the balance sheet. So as they push, new features out of FSD, it's going to come from the balance sheet and onto the income statement, right, in the form of revenues. That's going to be positive for gross margins. So it's great from a GAAP accounting standpoint because we're going to see a big uptick in gross margins as they push new features out. But I don't like to think of it that way because the revenue that they collect from FSD sales is already captured in cash flow. So, if they simply push out new features and therefore that triggers recognizing a whole bunch of revenue, that's going to be positive for gross margins. It's going to be positive for GAAP net income even. But it won't change cash flow and it won't change free cash flow because that number is already recognized in cash flow. Because remember, cash flow measures how much cash did they actually collect, right? So if someone pays for the full FSD option, that's money that Tesla has, taken into their bank account. Even though it sits on the balance sheet as a liability, it's counted as a part of their operating cash flow and therefore their free cash flow. So simply recognizing revenue is not going to do anything for their cash flow, free cash flow. What does interest me a lot, though, is the change in the take rate for FSD going forward, right? So if they start to push out new features, like for example, it's going to start to, we already saw that, that that autopilot can recognize, um, cones now. For example, you can start to see the visualization of the cones. And then if it starts to recognize stop signs and traffic lights and be able to navigate through local roads, that's going to be a big selling point for people to buy the FSD package. So therefore, that's going to be increased cash flow as well in the future as the take rate goes up. So simply shifting the money from deferred revenue to revenue is not going to do anything for cash flow. It's going to be great for gross margins.
It'll get the Wall Street analysts pumped, even though it's just
it's going to get everybody excited.
Moving numbers around on the computer, it doesn't change anything. But the analysts,
yeah, exactly, exactly. So if you're this is the problem that I have with GAAP accounting, is that people are going to get stoked because it's suddenly they have this huge jump in gross margins and therefore possibly a GAAP profit, but it's going to do nothing for cash flow. And I'm a cash flow guy. I'm a free cash flow guy. So I believe in the supremacy of free cash flow as well as operating cash flow.
Exactly. But this could be a reason why Tesla's GAAP statements now, their GAAP gross margin, which is already great for automotive standards, has been severely understated because they're not allowed to recognize all of this revenue because of this rule. But that's why the cash generation of Tesla's business is sort of underappreciated. And then I'm looking at the trajectory of this, and I'm like, this isn't a one-time thing. FSD prices are going up, attachment rates are going up. This, Tesla's structural gross margin is much higher than it looks on a GAAP basis, and that's not going away. I actually think that's increasing. The cash, GAAP gross margin is like 18 or 19% overall for the company. Cash gross margin might be 20 because of this FSD, and I only see that going up and up and up. And we talk about manufacturing improvements. Like, I guess the point I'm trying to get in with all of this is like at a long-term kind of true gross margin, even for a mass market car selling 45 grand or 50 grand, Tesla can be making 30%. And this is almost the entire thesis can boil down to that number. That's way higher. It's more of a Apple-esque computers on wheels company, and the margins will get there because of this software layer than just a car company. And that changes the whole structural profitability and valuation. And so that's what gets me like, and we're seeing it, my theory is every time the take rate hits 25% or some number, Elon goes, okay, we're raising the price pretty much along with features, when the new features come out. But so for me, this gets me very, very excited because this is over the next 12, for the next 3-5 years, do I just see consistent improvements in the price and take rate? Yes.
I think that's what I'm sort of focused on as well, because as they roll out, as they improve the functionality of FSD, that will change. Although that's not going to do anything for cash flow. What will change cash flow is a uptake in the take rate of FSD. So if more people who are ordering their Model Ys or Model 3s start to buy FSD, then that will cause a change, a bump in their cash flow. So that's what I'm watching as well. So it's not just a bump in gross margins due to recognizing that revenue, but it's also a bump in revenue itself if the take rate goes up. The big thing to watch, the couple of mega trends to watch is the operating leverage kicking in, the efficiency of returns on capital, specifically cash flow, return on assets, and return on equity. And then also watching the trend in that net debt number. So I think we're going to see a significant decrease in the effective leverage of the company. So to me, that's a trifecta. That's sort of a triple play because we're seeing growth, we're seeing competitive returns on capital, and we're seeing a balance sheet that's getting deleveraged.
Wow.
You don't really typically see all three things happening all at once for any given company. It's not very common to see that. And that's, I think, because of the fact that all three are happening simultaneously, that's, in my opinion, the primary reason why, the stock has soared the way it has.
Yeah. And you hit on an excellent point, which is as unique Tesla is from a product, what they're doing is so cool. Elon Musk, like from a financial case study perspective and just a fan of business, I feel like this is like, it's unbelievably unique and just fascinating and breaking so many rules. And like, it's probably the best business case study we've ever had since Amazon, playing out in real time. I would say probably more interesting than Amazon. And it's literally like playing out live as we, so I just think it's so, so cool to like kind of track the progress. And I can't wait to see how all these charts sort of like unfold with the Model Y, which is really this next piece of this whole story.
Yep, absolutely. It's going to be crazy.
Well, thank you so much for coming on the podcast, Mayur. This was awesome. Definitely would love to have you on again. People can follow you on Twitter. I believe you got a Twitter account, right? Fresh Jiva.
Yep, Fresh Jiva.
Awesome. Any final thoughts for the hyperchangers or words about Tesla, predictions, Q1, Q2, anything like that?
Yeah, just a word of advice. Don't do what I did and sell, because I sold about half of my shares thinking that this shutdown is going to, really hamper Fremont. So I'm regretting that, obviously. So don't do what I did.
Oh, you tried to get fancy.
Just buy and hold.
But you're a long-term Tesla investor, right? You're still holding some.
Oh, yeah. It's still my number one position.
Awesome. All right. Well, stay safe out there and have a good one. Thanks again, Mayur. Really appreciate it.
All right, man. Thank you. Yeah.